Good morning, everyone, and thanks for joining our Telemus webinar series today. Today we'll be discussing cash balance plans and whether they are a right fit for you. My name is Chris McKenzie. I'm a financial advisor here at Telemus Capital. I assist business owners with evaluating their qualified retirement options, including 401ks, profit sharing plans, and cash balance plans. Joining us today is Brian Smith. Brian is the Midwest Sales Director for July Business Services, which is a TPA and record keeper, and he has more than 18 years of experience in the retirement planning industry. In his spare time, Brian is a member of Team Honor, which is an organization that supports families of fallen soldiers. And additionally, Brian is an avid Ohio State fan, but don't hold that against him today. Brian, welcome. Thanks for joining us.
Thank you, Chris.
And we have the slides showing if you're following along online. We'll be going through this presentation. This will also be posted at the end through email as well. If you have any questions throughout the webinar, you can type them in the message center and we'll take care of those at the end. For the agenda today, we're going to start out talking about what a cash balance is, a very broad overview, why it might be beneficial to implement a cash balance plan. We'll go through the best candidates, the compliance testing, the different contribution requirements, and at the end, we'll go over how to get started for 2019 if you're interested. All right, Brian, how about you start us off, giving us the broad overview of what a cash balance plan is?
Sure, Chris. Thank you very much. And everyone in attendance, really appreciate your time this morning. Like Chris mentioned, if there are any questions, please do not hesitate to type that in the chat section over there on the right. This topic at times can be a little complicated or a little confusing, and we'll do our best today to make sure that we stay pretty high level. So with that, a cash balance plan is actually a type of defined benefit plan. So you have two types of retirement plans that a business may have. It's a traditional defined benefit pension plan, or you have a 401k profit sharing plan, which we call a defined contribution plan. The cash balance plan, again, being a type of defined benefit plan, has many features or has some similarities to a profit sharing plan. Thus, we a lot of times refer to these as a hybrid plan. But again, it technically is a defined benefit plan where we are defining a future benefit. The investment risk is to the participant in a 401k plan. It is on the employer or plan sponsor in a defined benefit plan. A profit sharing plan, contributions are discretionary. In a cash balance plan, contributions are required. In a 401k plan, participants manage their accounts and have individual accounts. And in a cash balance plan, it's pooled together into a group account. So that's a little bit about, again, what a cash balance plan is. And then at the end, the name of the plan, cash balance, comes from the fact that there is a lump sum at retirement instead of an annuity. And we got a chart coming up here in a little bit that will kind of show the differences or side by side. Yeah. But if you go back one, Chris. Yep. So one of the things you're going to see in a cash balance plan is that a person has a hypothetical account balance. And Chris, if you go back one prior slide. Yep. So each participant will have a hypothetical account balance that an actuary, because a defined benefit plan requires an actuary, we are calculating that every year. There are two parts to this account balance. There is the contribution, which we call a credit, and then, or a contribution pay credit, and then there is a guaranteed interest rate assigned to the contribution. Most cash balance plans today are using somewhere around 4 or 5%. But both contribution credit.
Brian, just to hop in for a second on the 4 or 5%. So on the investment side, we're investing the pooled money for the plan, and we're not trying to go for a home run, trying to get the highest performance every year. We're actually trying to get within that 4 to 5% range for that interest credit.
Yep. So both that promised interest return and that contribution are actually spelled out in a plan document. And then that is what the actuary uses each year to calculate the future benefits for everybody. And that is your hypothetical account. So on this next slide, you'll see kind of this side by side from a traditional pension or an annuity type of pension plan, a cash balance plan, and a 401k plan. So
And
contribution.
a cash balance, just to be clear, a cash balance plan can be in accordance with or in addition to a 401k profit sharing plan.
Yeah,
They
yep.
can work side by
Say
side.
that. Yep. Yeah. So many times, and a business may have a 401k profit sharing plan where we're what we're calling maxing out the retirement benefits. That limit is $62,000 for the 2019 tax year. And so many business owners might be looking to do more. And this is where the conversation really starts is can we do more? And the answer is yes, by adding on a cash balance plan.
Right.
And as you'll see, the contribution levels, there really isn't a limit per dollar amount. There's a limit based on age and compensation, but it could be 2, 3, 4 times what you might be able to do inside a 401k plan. Again, the investment risk is on the client or the plan sponsor in a defined benefit plan versus an employee who's managing their 401k account. Cash balance plans, again, the employee does not get to direct those investments that Chris was referring to. It's in a pooled account, and the employees do not have a say on how that is invested, et cetera. So a couple more things there, but the biggest takeaway from here, again, is that it is a qualified plan. It is a strategy that is usually added to a 401k plan, and there are 2 parts to the cash balance plan: a interest credit and a contribution credit. And then Chris, I think you're going to take this one.
Yep. So why implement a cash balance plan? One of the main benefits of doing so is you can maximize your contribution as an owner of a business. Like Brian said, for a 401k profit sharing, you can max out at $62,000. But for a cash balance plan, you can put away a lot more tax deferred dollars. This helps for business owners who may have in the past been putting money back into their business in order to make it grow, and now they're to a certain age where they see retirement in the near future, and they want to catch up, so they can accelerate those investment savings. It's a tax efficient vehicle. Not only that the tax deductions on the employer side, but also for the retirement savings themselves are tax deferred. The cash balance plan provides some asset protection in the event of a lawsuit or bankruptcy, and it's a great way to attract or retain new employees or current employees. It might differentiate yourself from a competitor in the same industry. And this slide here is a good slide that shows the contribution amounts that can be put away. The blue bar shows the 401k and profit sharing max, which is $62,000, and the green bar shows the potential cash balance contribution credits. And you can see as you get older in age, that contribution credit increases. And at age 65, there's potential to be putting around $250,000 tax deferred into this plan. All right, Brian, you want to talk about the best candidates for this type of vehicle?
Yes, sir. So I often get asked who is an ideal candidate, Brian, for a cash balance plan, and you'll see some circles here, and all of these are true, meaning professional firms, firms that have some age disparity between the ownership and the staff, firms that are already contributing to a profit sharing plan, business owners that desire, like Chris mentioned, a greater and significant and immediate tax deduction, a business owner wanting to play catch up on their retirement savings and accelerate those retirement savings. But if you go back one more, Chris, the number one candidate is that gray circle, and that is a business that has predictable and steady cash flow or profits. That truly is the number one factor in all of this. And then regardless of what type of industry you're in, regardless of how you're taxed as an entity, regardless of all of this, the biggest decision is going to be cash flow and profitability. And the reason is that if you remember from the earlier slides, there was an obligatory funding requirement. A defined benefit plan has a required annual contribution every year versus, again, a profit sharing plan that can be completely discretionary. So we want to make sure we have the cash flow and the profits to be able to comfortably commit to this strategy for 2, 3, 4, 5 years or longer. Then more specifically, Chris, the next slide, if you look at the firms that are, or the type of businesses that are adopting cash balance plans, it's overwhelming in your more professional services type companies, physicians, dentists, chiropractors, optometrists, anesthesiologists, orthopedists. And the reason is because their profitability, their cash flow is pretty predictable. Right? Even in a downturn in a market, in an economy, people are still going to the dentist. People are still going to the doctor. And so their cash flow is a little bit more predictable. And then you'll see legal, law firms, accounting, financial institutions. So, you know, this slide here makes up probably half of the types of entities that adopt plans. However, I have set up a few hundred of these over the last number of years, and I can tell you that everything from construction to plumbing to a scrap yard to manufacturing, retail, t-shirt company. I mean, truly anybody can adopt this strategy. It's just cash flow is the biggest driver. And what's not on here is owner only. A single sole proprietor or a single member LLC can definitely adopt this strategy. And again, the same like everybody else, the driver or the catalyst would be, what does cash flow look like?
And Brian, what happens if a business owner cannot meet that required amount needed for the contribution?
Yes, great question, Chris. So depending on what benefit is written into the plan document, and depending on how the asset is performing versus the liability, right, the future benefit, the actuary is going to produce a range of funding every year for the client. So maybe in a year where they don't have the same amount of cash flow, they can at least minimally fund. I'm just going to make numbers up here, but let's say their maximum was $200,000 that they wanted to put in, and the minimum might be like $70,000. Something like that, where there will be a range of contributions available for the business owner. Now, if we're concerned about future years, what we can do inside a cash balance plan is what we call freeze a defined benefit plan. So that, let's say right now, we're concerned about 2020. We're not sure if a contract's going to be renewed. We're not sure if we're going to have the same cash flow. We can prospectively do what's called a freeze, so that no more contributions would be required in the next year. And then when that year is running, we can decide if we want to unfreeze it for the next year, run it frozen again, or terminate the plan. So there is some flexibility when we talk about that required contribution. We want the client to feel comfortable that they can commit to that even in a poor cash flow year, but that there is some flexibility if it got to the point where they really couldn't make it. We could try to minimally fund. We could amend a plan. We could freeze a plan. You know, things like that, Chris.
Yep. All right. Let's get into an example here with one business owner, and we can talk about how. Walk us through this plan.
Yeah, so what you see here is actually a very real business. It could be a dentist office here. This could be a retail, coffee shop. Well, maybe not a coffee shop, but a plumber, electrician, really any type of business where you have one business owner, age 50. The W-2 compensation for this business owner is over $280,000. So we just put that there because that's the IRS maximum. There are 5 employees ranging from age 45 to 25. And you see the employees' compensation ranges between $30,000 to $50,000. The first column always in these defined benefit cash balance 401k combination plans is the 401k contribution. So the maximum 401k contribution for this year was $19,000 plus $6,000 if you were over the age of 50. So that's how we get $25,000 in the 401k. Chris and I talked about the limit of $62,000 then being the limit in the 401k profit sharing plan. That difference is made up in the form of profit sharing. So $37,000 in profit sharing plus $25,000 in 401k is how a business owner would get $62,000. And then the third column here, cash balance contribution. So if you're looking at this example in front of you, and if you're not, I'll try to explain it. Roughly what all of the, and we're going to have a slide coming up here, benefits to the staff are based on, or what benefits are going to the business owner. But in this example, you can see that, roughly 90% or 90 cents of every dollar going into this plan is going in for the business owner. And at the end, when he's been told or she's been told that the maximum is $62,000, and by adding the cash balance plan, we now go to $230,000, and that costs us probably a little over $20,000, $25,000 to the staff.
Right.
Which
So
created
yeah. Brian, just to put it in different terms, so the business owner for $20,000 that he's provided, or he or she is providing to their employees,
yep,
they're receiving the $230,000 into the
that's right
cash balance plan.
That's right. Correct. Well, into both plans, into their cash balance 401k plan. That's correct.
Correct. Yep. So it's a pretty good deal in that regard.
Yeah, it's phenomenal, and all of those dollars in the profit sharing plan and cash balance plan then are the tax strategy that you talked about, Chris, on your slide. That is a business expense. That is a above the line deduction. That is lowering the qualified business income or the adjusted gross income of the business owner. And again, creating a very significant and immediate tax deduction. In this example, 200, we're probably looking at 250,000. And if you figure the top bracket of 35% on 250,000, this was a tax savings of over $87,000. And I always tell the business owner, would you like to write the check to yourself and your employees or the IRS? Those are your only two choices. And,
right.
And so, yeah, it's a pretty effective tax strategy.
Yep. And then
here's an example. Yep. I was just going to say, this is just two business owners. So you can see that between the two of them, each doing, $230,000, you're talking at, $500,000 between the two of them, again, at a cost that did not change to the staff. The same roughly $20,000 or so to the staff for the two business owners now to benefit versus one.
Right. And when we provide illustrations through July, we receive the information on your company's census, and we'll provide you the exact example like this to show you how much hypothetically you can be putting away in your cash balance plan, including the profit sharing and 401k aspect as well. All right, Brian, you talked about the income and tax structure a little bit, but you just want to touch on that.
So yep. So and quite simply, all qualified plans. So in your SEP IRA today, your simple IRA, your 401k, profit sharing plans, and then cash balance plans, the income that is used for retirement plan purposes is what the IRS calls earned income. And that is income that has had full self-employment taxes applied to it. So when we're getting into am I a right fit, and we're looking at compensation, it's important that we, again, have enough earned income and to know the difference between passive and earned income. So I'll give you one example for business owners who are electing to be taxed as a subchapter S, or what we call an S corp. The income for an S corporation that is used for retirement plan purposes is the actual W-2 that the business owner is taking. all of the other income that is being passed through to that business owner is not able to be used as earned income because of the avoidance of certain self-employment taxes, mainly FICA. Now, that is profit, right? That is cash flow. That is used to make the funding contribution, but that is not used in the calculations. So a couple of things here. Note that rental income is usually not earned income. Investment, dividends, capital gains, those things are not earned income. So depending on, again, how you're taxed, if you're a Schedule C or an LLC on a 1065 or an S Corp, we would discuss, what income is used for retirement plan purposes.
And then it's important to understand the different pitfalls that come along with the cash balance plan. Brian alluded to this earlier. The plan must be permanent in the eyes of the IRS, and that possibly could mean that the plan might need to be open for up to 10 years. But I think, Brian, what you've seen, it probably isn't. It doesn't actually have to be open for 10 years necessarily, but that's on the safe conservative side.
That's right.
We also talked about that the funding it's non-discretionary, meaning every year you're going to be provided a minimum, a recommended, and a maximum amount that you can fund the plan. But moving forward, the plan does need to be funded yearly, but there are options if that funding cannot be made, including freezing, which was talked about earlier as well. If the plan needs to be amended in any way, there will be fees to do that, obviously, if you want to change the contribution formula from year to year. And then every year, the TPA record keeper receives the company census, which can have an impact on the plan design. So turnover in employees and new hires could impact the design from year to year. So those are a couple things that you need to take into consideration. And then, in addition, there are compliance testing that comes along with these types of plans. And Brian, if you want to touch upon that.
Yeah, we'll try to keep this really high level because no one really wants to get into the weeds with the testing. But as a qualified plan, just like the 401k plan, there are rules that must be followed per the Internal Revenue Service, the IRS, and the Department of Labor, the DOL. And so one of the very first things with a cash balance plan is that so many people have to be receiving a benefit. And you'll see in the first blue box there, it's 40% of the total eligible employees, or 50, the lesser of, must receive a meaningful benefit. And a meaningful benefit is defined as a 0.5% of pay benefit at retirement age. A lot of times that's pretty low in a present value calculation. I think you saw in some of those examples, it was $700, it was $1,000. So again, a meaningful benefit. A certain amount of people must benefit, and then that dollar amount of that benefit must be at least a 0.5% of pay annuity at age 65. And then we have regular non-discrimination. My bad. Go ahead, Chris.
Just in very simple, layman terms, essentially the business owner or the business owners can receive all of the benefit for the plan. There needs to be something going to the employees as well. And that's what the meaningful benefit test accomplishes.
Yeah, and that's really the next two as well. It's the same principle, is that it cannot be discriminatory just for the business owner. That there will be minimum benefits that have to go to eligible rank and file employees, and we call that non-discrimination testing. And then on average, the percentage of a benefit to the employees in the profit sharing plan will be somewhere between 5 to 7.5%. And then again, that meaningful benefit in the cash balance plan. So we don't need to get any deeper in there. So just know we have to cover a certain amount of people. It has to be non-discriminatory, and there's a minimum amount of benefits that must go to the staff. The contribution then that Chris has referred to and that I've mentioned, again, that is required annually, and there will be that funding range every year. And the biggest thing to understand here is that contribution range will change every year, depending on how the account has performed. Again, the plan and the actuary are calculating a future benefit. That is the liability to the business. How the plan is currently doing today, that is your current asset. And so if the plan were to be shut down, is there enough money in there to pay out benefits? That is how all the testing in a traditional defined benefit works as well, is what is the funded status? Are we overfunded or are we underfunded? And again, depending on that range, you might have 1 year where you can receive quite a large deduction. And another year, maybe not as much because you've accrued too much of a benefit. So just know that that range will change. And then again, unlike a profit sharing plan, that there is an obligatory, mandatory, sort of obligation that this is not discretionary. And we want to commit to a couple of years to being able to do this strategy.
So if you're interested in potentially setting up a cash balance plan, here is the proposal process. What happens is we collect the data about you and your company. We create a proposal along with July that gives you a customized report, and then we'll sit down and review it with you to see if it's a good fit and if any adjustments need to be made. That being said, the deadline for opening a cash balance plan for 2019 is quickly approaching. So if you do want to make those contributions or get a plan up and running for the 2019 plan year, you really do need to move pretty quickly. You have to have a cash balance plan document signed by December 31st, 2019. And in reality, in order for us in July to get those documents in order to be signed, we need to have a service engagement paperwork by December 17th. So if you are interested, you really should reach out sooner than later so we can get this process going. Brian, do you have anything to add before we open it up to questions?
No, not really. To reiterate that deadline, again, this is if you want to take advantage of the tax deduction for the 2019 year. This does not mean the money has to be contributed or deposited into the account before the end of the year. So the one thing I do want to make that point is we have to have a signed plan document by December 31st. That's proof to the IRS that you have a plan. But funding, the contributions are not owed until up until the time you file your corporate tax return. If you extend your corporate tax return, that date next year is actually September 15th. So you have until September 15th next year to make the contribution for this year. So that gives some people some time to maybe escrow some funds or set aside the funding. But just know, again, if you want the tax deduction for 2019, we have to have a document signed by December 31st, 2019. So that's it, Chris. Really appreciate it, man.
All right, well, it looks like I'm going to wait 1 second to see if Matt Rand is on to give us some questions.
I am. We have one question. So, what happens to employees' hypothetical accounts if they quit or are terminated?
What a great question. So similar to a profit sharing contribution, a cash balance hypothetical account will have a vesting schedule attached to it. And in a cash balance plan, there is a 3-year cliff vesting schedule. So what that means is an employee would have to be with the company for at least 3 years before they are entitled to receive benefits upon separation. If they did not meet 3 years and they terminated, they forfeit 100% of the hypothetical account balance. The business owner then and the plan itself will actually use that forfeiture amount towards future years funding, meaning the promised benefit for the future and the account is worth X, we can apply that forfeiture towards that future benefit promise. Similar in a profit sharing plan where it can be reallocated or applied to next year's contribution. The forfeiture would stay inside the trust and again applied towards the future accrued benefits. So that's a great question.
Mm-hmm.
Sorry, we actually have one other question. So if the cash balance plan performs better than expected, does the business owner collect the difference?
So that's actually another fantastic question. So if the plan had performed better than the expected and you have a surplus, in a year that you go to shut this plan down, that actually will be a problem. If it's a year where it's not being shut down, again, that funding target range just changes. And maybe you don't make the maximum contribution for that year. You make a lesser amount so that the asset and the liability, again, are equal. But it is critical to understand if there is a surplus in the year the plan is to be terminated or shut down, that entire surplus amount now comes with a 50% excise penalty tax and is all non-deductible. So this is why we encourage every year to have a planning meeting with the financial advisor. So with Chris, with your public CPA, with your certified public accountant or your tax planner, and with us to know what's the plan for the next year, what's the plan for the next 2 years. Because again, we don't want to run into this situation where you have an extreme surplus in the year the plan is to be shut down. So the answer to that question is most definitely not. The excess does not go to the business owner. In fact, it's quite the opposite. But a great question.
Yep, great question.
All right, I think that's all we got.
All right. Thanks everyone very much. If you have any other questions, feel free to reach out to Brian or I. Have a great weekend. Thanks.
Yes, thank you, everybody.